Hello and welcome to Hardman Talks. I'm Larissa Adams and I'm here with Hardman & Co.'s property analyst, Mike Foster. Mike, hi there. It's good to have you back for part three of our series on REITs. How are you doing
Thanks.
today?
Yeah, very good. Thanks very much.
Good, good. Okay, so Mike, previously we've looked at REIT prices versus NAVs and how NAVs behaved going into 2024, including the effect rent prices were having. So actually, how about we pick up from where we left off on rental value and how vacancies are now factoring into the picture?
The largest sector for the UK commercial real estate market is the office sector. And like you were saying in an earlier REIT talk, we illustrated that in the long term, in the past half century, the rental value preservation is fairly neutral, even in its strongest market, which is London. So nonetheless, these are real assets, and when the inflation shock that we're having dies down, occupies in areas of demand that is distinctly not Docklands, and we'll come on to that, may have to pay more in rent simply because new build costs are so permanently raised and vacancies are low in those strong areas. So we're going to look at vacancies, at rents, valuations, and we're going to focus on London offices and how they're stood now. The most recent large UK office investors to report results was Derwent London.
Yeah, and I think they've given us quite a lot of food for thought. So maybe we can
Yeah, yeah.
expand on that. And I mean, how do you think what your insights would be given their performance, and do you think that they're a good indicator for what's happening with asset values?
Yeah, so they're definitely one of the larger UK office investors. So they're an office investor, also a developer, and they saw their 2023 gross asset values written down by 10.6%, which translated to a 13.8% net tangible asset reduction due to the 28% period end loan to value effect. That 10.6% reduction compares to a 6.8% reduction in 2022. So the 23 position can be summarized as no material rent changes. The value is estimating future rents actually very slightly 2.1% higher, but ongoing valuation damage due to rental yields rising.
Okay, so what are some of the drivers influencing asset valuations right now, and how is this tied back to Derwent?
Yeah, vacancies does affect it. We'll show a vacancies chart later and also go into floor space take up. But here on this chart, here are valuation drivers. You can see the big and ongoing rises in yields are the major issue here. Over these past 2 years, West End has fallen 17.4% in value, and Derwent's City Borders has fallen 25% in value. Overall, like I said, the rental values actually rose modestly by about 2%, but the yield basis here on this chart much more than reversed that benefit. Remember, valuers see rents rising slightly in the future from here. As to valuations, falls, again looking at the chart, only started in the second half of 2022 and accelerated in the second half of 2023. See that last blue bar on this chart? So it's definitely not over. Dent London has 2% of its assets in provincial locations, and those fell a lesser 5% in value in 2023. Looking at total property return in 2023, Derwent fell 7.3%. MSCI, the market index, Central London Office, 7.9%, and MSCI All Property fell 1.0%. So that shows that offices are doing distinctly worse than the UK real estate market as a whole. In the last talk, we reminded investors that retail seems to have found a value bottom, and other assets like logistics or student accommodation asset values are rising. The cheaper Derwent London office assets, they define cheap as under £1,000 per square foot lost value more, indeed twice as much as those worth over £1,500 a square foot. So let's spend 3/4 of a minute on details, then we'll get back to a broader picture. So Derwent is actually doing pretty well with low gearing and good modern assets. It's substantially profitable. EPS were 3.2% of the NTA, and an increased dividend was paid. Net rental income fell by 1.4%, which included minimal disposals and developments. Breaks and voids hit income 3%, but lettings, refurbishments and developments added 8%. Property running costs such as tenant service repairs and ground rent were all small numbers but rose. Having risen in the second half of 2022, voids fell in the second half of 2023. 68% of the portfolio is EPC-B compliant, which is quite a big issue these days, and to upgrade the rest by 2030, which is needed, will cost 95 million. Quite a lot of money. 95 million is 6.2% of the value of the EPC target non-compliant assets. So one marker of reduced stress is the share price, but we also like to look at its bond, which matures in 2031. And through 2023, the yield spread over gilts of Derwent's 2031 loan stock did improve. It improved from 2.8 to 1.8%, and it's currently only 1.4% spread over the relevant gilt. Total debt interest cover is 4.1 times.
Thanks, Mike. So I think let's maybe look at the office market. We've got a chart on screen here, and clearly empty desks it's still a big problem. So what else are we actually seeing here?
Yeah, so the chart's showing offices' individual occupation in different major markets. So here we see the major problem, really, which is those empty desks. And here we chart, according to JLL, the occupancy levels of let buildings. I guess it's some kind of desk count multiplied by weekdays. And it's in the Americas, the Asia Pacific and Europe, those three lines. I believe the Americas is highly weighted to the USA, but from other data we have, the UK level seems currently to be pretty much the same as continental Europe. So that's just the background of how that's put together. So what are the trends? The Americas has stalled at only 50% full, whereas the UK Europe runs at over 75%. And that's a huge driver, because a building at 75% is something the tenant is likely to consider feasible ongoing. At 50%, however, the US level, there's a real chance of a more structural, more permanent downshift. We as yet have no data by type of tenant, but there may be an element of tech space perhaps, though that goes against the other factor, which is that younger employees are doubly disadvantaged by working from home now, I think. So let's turn back to Derwent London commentary. London office in demand in 2023 was a take-up of 10.5 million square feet. So what's that? This is 8% below the 10-year average. Not great, but not bad. London outside City and West End is only 16% of its space and far less of value. London outside City and West End is running a little over 10% below the 10-year average. Something weird is going on in high levels of active demand. Tracked active demand for central London office space reached an all-time high at the turn of the year, after take-up in 2023 exceeded forecasts to a record 9.62 million square feet. That's according to Cushman and Wakefield, or 10.5 million according to CBRE. Mind you, that 2023 take-up was below the 10-year average of 12.1 million.
Okay, and we've got a chart here, and that's showing active demand by business sector. And I see, according to CBRE, the active demand is 9.9 million square feet, and that's up from 5.7 million end of 2022. So what else is being implied here?
Yeah, so we're looking at the drivers. We've looked at the valuation. Now we're looking at the actual sort of occupiers and vacancies. So if we look at the active demand by business sector, which I just said is sort of fairly healthy, and this is London we're looking at. It's well spread. This is data from Derwent London and CBRE. So Dent London 2023 results point to a recentering of offices, by which I mean large and small occupiers moving to city central locations away from office parks. There was a comment in the Financial Times 3 weeks ago on the recent sale of 5 Churchill Place, a very big office block in Docklands, at a value half the acquisition cost of just under a decade ago. This is a foreclosed Chinese seller, and I do actually remember at the time the super high prices being paid by Chinese Hong Kong for another central London office. As I say, this 5 Churchill Place is Docklands. So we can look at a different chart here, and this is looking at the vacancy. So we've looked at the demand, we're now looking at vacancies, and we're looking at the sub-markets in London. And I've just said that we've had news in the market that's nothing to do with Derwent London of this 5 Churchill Place selling at what seemed like a pretty low, pretty fire sale price, and that's in the Docklands. So how does that halving in value tie in to the falls that Derwent London were talking about of 17% in the West End and 25% in city borders over the past 2 years? That is the Derwent London numbers that I've given. And that 2 years ago was the peak value in the values estimates. But you know, this Dockland building is halved in value. Well, people like people, and shops and evening entertainment, and Churchill Place is in the Docklands. And frankly, there's a vacancy-led argument that West End should not fall in rental value. And indeed, that's what Derwent London valuers are stating for end 2023. Value falls are driven by the yield capitalization rates. They're not driven by vacancies or rents falling. So, you know, the Docklands is a very instructive point in terms of those big vacancy rises in that particular submarket. So yeah, so we've got to look at specific markets, and as to Docklands in particular, ouch. As we said in previous REIT talk, the office rents in the best locations in Britain, London, have at best held real levels over the decades. They've not risen, and elsewhere they've fallen. So it's lukewarm at best in terms of rental value preservation, the office sector. Nonetheless, these are real assets. And when the inflation shock dies down, occupiers in areas of demand, definitely not Docklands, may have to pay more in rents simply because the new build costs are so permanently raised and vacancies do remain low in the strong areas. But we've stated London office demand in 2023 was a take-up of 10.5 million square foot, only 8% below the 10-year average. We do prefer so-called alternative in real estate investments like logistics, but we have some pockets of resilience even in offices, as I hope we've explained in the detail here. Our next talk will be in a few weeks.
Thank you, Mike. Looking forward to it. Again, this is always extremely valuable for investors, and thank you to our viewers as well. Please don't forget to like this video and join in the conversation by commenting and sharing your thoughts below. We appreciate your time, and we'll see you back here on Hardman Talks. Thanks.